Hey there, moneymakers! Welcome back to another exciting episode where we dive into the world of finance and investing. Tired of your boring old buy and hold strategy? Feeling like your portfolio needs a little more excitement and a lot more potential for profit? Looking for a way to spice up your portfolio and maybe make some extra cash? Well, you're in the right place. Well, strap in, because today we're talking about the options trading strategy that's smoother than a freshly paved road, the wheel strategy. It's a method that can potentially turn your investments into a steady income stream. Now, don't let the name fool you. This isn't about picking stocks blindfolded while spinning around in your office chair, although that does sound kind of fun. It's a strategic approach that requires some know-how and a bit of patience. The wheel strategy is all about generating income by selling options, specifically covered puts and calls. It's a way to make your money work harder for you. Think of it like being a landlord for stocks, but without the late-night calls about leaky faucets. Instead, you're collecting premiums and managing your positions. This strategy is perfect for investors who like the idea of getting paid to wait. It's a way to earn income while you hold on to your favorite stocks. You're basically saying to the market, hey, I'm willing to buy this stock at this price, and I'll even pay you a premium for the privilege. It's a proactive way to manage your investments. And if the market doesn't play ball, well, you get to keep the premium anyway. It's a win-win. You either get the stock at a discount, or you keep the cash. So, are you ready to spin the wheel and see where it lands? Let's dive in and explore how you can make the wheel strategy work for you. Alright, first things first, let's talk about selling puts. Don't worry, it's not as scary as it sounds. Remember those stocks you've been eyeing but aren't quite ready to buy yet? Well, selling a put is like putting a for rent sign on them. Here's the deal. When you sell a put option, you're giving someone else the right, but not the obligation, to sell you 100 shares of a specific stock at a specific price, the strike price, before a specific date, the expiration date. In return for this privilege, you get paid a premium. Think of it as rent money for your stocks. The best part? You get to decide the price and the date. Want to rent out your hypothetical Apple shares for $150 each and get paid $5 per share? Go for it. Just remember, if the stock price falls below your strike price by the expiration date, you might have to buy those shares. But hey, at least you got paid for your troubles, right? Let's say you've got your eye on Apple, AAPL, but you think the current price is a little too steep. You decide to sell a put option with a strike price of $150 and an expiration date of 1 month out. The premium you receive is $5 per share. Now there are two possible outcomes. 1. Apple stays above $150. Congratulations. The option expires worthless. You keep the $500 premium, 100 shares times $5. And you can even sell another put option for the next month. 2. Apple drops below $150. Uh-oh, looks like you're now the proud owner of 100 Apple shares at $150 each. But don't panic. Remember that $500 premium you pocketed? That effectively lowers your cost basis to $145 per share. Not too shabby, right? So, you sold a put option, and the unthinkable happened. The stock price tanked, and you got assigned. Don't worry, it happens to the best of us. Remember, this is part of the plan. Think of it this way. You just bought a stock you liked at a discount. You were already willing to buy it at the strike price, and now you own it for even less thanks to the premium you collected. See? It's not so bad after all. Now you've got a decision to make. Hold on to the stock and hope it goes back up, or sell covered calls and start generating even more income. Speaking of covered calls. Section 5. Step 3. Selling covered calls. It's raining cash, hopefully. Now that you own the stock, it's time to put it to work. Selling covered calls is like renting out your stocks again, but this time, you're the landlord collecting rent while still owning the property. Here's the gist. When you sell a covered call option, you're giving someone else the right to buy your 100 shares at a specific price, called the strike price, before a specific date, the expiration date. In exchange, you receive a premium, just like with selling puts. The key difference here is that you already own the stock, so you're covered if the option buyer decides to exercise their right to buy. If the stock price stays below the strike price, you keep the premium and the stock. If it goes above the strike price, you might have to sell your shares. But hey, you'll make a profit on the stock sale plus the premium you collected. Section 6, example, Tesla, to the moon or bust. Let's say you got assigned those 100 Apple shares at $150 each. You decide to sell a covered call option with a strike price of $160 and an expiration date of 1 month out. The premium you receive is $3 per share. Here's how it could play out. 1. Apple stays below $160. You keep the $300 premium, which is 100 shares times $3, and still own the shares. Time to sell another covered call and keep the cash flowing. 2. Apple blasts past $160. Your shares get called away, but you sell them for $160 each, making a $10 profit per share on top of the $3 premium. That's a 13% return in just 1 month, not too shabby for a stock you were forced to buy. Section 7. Benefits Cha-Ching, potential profits and discounts galore. Alright, let's talk about why the wheel strategy is so popular. First and foremost, it has the potential to generate consistent income. Remember those premiums we talked about? Those are pure profit that gets deposited straight into your account. And the best part is, you can keep selling options month after month, creating a steady stream of cash flow. Second, the wheel strategy can help you buy stocks at a discount. Remember how you get paid a premium when you sell puts? Well, that premium effectively lowers your cost basis if you get assigned. It's like getting a discount on a stock you already wanted to buy. And finally, the wheel strategy can help you manage your risk. By selling covered calls, you're limiting your upside potential, but you're also protecting yourself from downside risk. It's a great way to generate income while staying invested in the market. Section 8. Risks. Buckle up, market dips, and stock slides. Now before you get too excited, let's talk about the risks involved with the wheel strategy. Just like any investment strategy, it's not without its downsides. The wheel strategy, while potentially lucrative, comes with its own set of challenges and risks that every investor should be aware of. First and foremost, the wheel strategy requires you to be comfortable with options trading. This isn't something you can just jump into without preparation. You need to understand the concepts of puts, calls, strike prices, expiration dates, and all that jazz. These are fundamental concepts that you must grasp to effectively use the wheel strategy. If you're not familiar with options, it's important to do your research before diving in head first. Take the time to educate yourself through courses, books, and practice. Second, the wheel strategy can expose you to unlimited risk if you're not careful. This is not a risk-free strategy by any means. If you sell a naked put, meaning you don't have the cash to buy the stock if you get assigned, you could lose more money than you initially invested. This is a significant risk that can lead to substantial financial loss. That's why it's crucial to only sell options on stocks you're comfortable owning. Make sure these are stocks you believe in and are willing to hold for the long term, and to always have enough cash on hand to cover your positions. This ensures that you can handle any assignments without financial strain. And finally, the wheel strategy can be time-consuming. It's not a set-it-and-forget-it approach. You need to constantly monitor your positions, keeping a close eye on market movements and your own trades. Adjust your strike prices and expiration dates, making sure they align with your investment goals and market conditions, and make decisions about whether to roll over your options or let them expire. These decisions can significantly impact your returns. If you're not willing to put in the time and effort, and if you don't have the discipline to manage your trades actively, the wheel strategy might not be right for you. It's essential to assess your own risk tolerance and commitment before diving in. Section 9. Wheel you do it? Tips for beginner wheelers. So, you're ready to take the wheel strategy for a spin? This strategy can be a fantastic way to generate consistent income, but it requires a solid understanding and careful planning. Here are a few tips for beginners. 1. Start small. It's tempting to dive in head first, but it's wiser to begin with a manageable amount. Don't go all in on your first trade. This way, you can learn the ropes without risking too much of your capital. Begin with a small amount of capital and gradually increase your position size as you gain experience. This gradual approach helps you build confidence and skill. 2. Choose your stocks wisely. Not all stocks are created equal, and some are better suited for the wheel strategy than others. Only sell options on stocks you understand and are comfortable owning. This ensures you are prepared for any market movements. Avoid volatile stocks or companies with uncertain futures. 3. Manage your risk. Never sell naked puts, as this can expose you to significant losses. and always have enough cash on hand to cover your positions. This financial cushion can protect you from unexpected market downturns. Consider using stop-loss orders to limit your potential losses. 4. Be patient. The wheel strategy is a marathon, not a sprint. The wheel strategy is a marathon, not a sprint. It requires time and patience to see significant results. Don't expect to get rich quick. Instead, focus on building a steady stream of income over time. Focus on generating consistent income over the long term. This approach will help you build wealth sustainably. 5. Don't be afraid to ask for help. The world of options trading can be complex, and seeking guidance can be invaluable. There are plenty of resources available for options traders, including books, websites, and online forums. Engaging with these resources can provide you with insights and strategies from experienced traders. Don't be afraid to reach out for help if you need it. Networking with other traders can also offer support and advice. The wheel strategy can be a powerful tool for generating income and managing risk, but it's important to understand the risks involved before you get started. Educate yourself thoroughly to avoid costly mistakes. By following these tips and doing your research, you can increase your chances of success and spin your way to financial freedom. Remember, the journey to financial independence is a continuous learning process.